This podcast is for informational purposes only and does not constitute financial advice. Consult with a qualified professional before making any investment decisions.
Welcome to the Wire Weekly Roundup. The week in real estate presented in digestible bites. Hold on while our AI hosts take us on another ride through this week's top real estate headlines.
Welcome back to The Wire, the weekly deep dive to help you, our real estate agent listeners, stay ahead of the curve. Spring is here, right? But the market is sending us some seriously mixed signals. I mean, we've got mortgage rates dropping, but sales are lagging behind. What gives? Luckily, we've got our expert here. They've been poring over all the latest reports from Freddie Mac, Redfin, Altos Research, and even some economic forecasts. And let me tell you, there are some really interesting, even surprising things we found that'll help you guide your clients through this market. First up, let's talk about those dropping mortgage rates. Freddie Mac says the 30-year fixed rate has been falling for 7 weeks straight and hit its lowest point since December, down to 6.63%. That's a pretty big deal for buyers who might have been priced out just a few months ago. Like imagine you're working with a first-time buyer looking at a $400,000 house. With a 20% down payment, that lower rate could mean a monthly payment of about $2,050. Not bad, huh?
It's definitely good news for buyers, especially in a market where affordability has been, a huge concern. But here's the interesting thing. This drop in rates, well, it's partly fueled by economic uncertainty. Investors are getting nervous about, things like inflation and potential slowdowns, so they're moving their money into safer investments, things like bonds. That drives bond yields down, and because mortgage rates are tied to those yields, they drop too.
So it's like a silver lining to a potentially stormy economic cloud. But the question is this just a temporary dip? Or is this a sign of a bigger trend? Like, should we be telling our clients to lock in these rates now?
That is the million-dollar question, isn't it? It's really tough to say for sure. I mean, the Fed's next moves, global events, even the upcoming election, all of that could impact rates. This volatility makes it even more important to stay informed and make sure your clients have the most up-to-date advice.
Absolutely. Okay, so we've got lower rates, and normally you'd think buyers would be rushing in. But Redfin's data is telling a different story. Pending sales are actually down 6.4% year over year. It's like everyone's hitting the brakes, even though gas prices, or I guess in this case, mortgage rates, are going down.
Yeah, it's true. And the reason for all this hesitancy, well, affordability is still a massive factor. Even with the rate drops, home prices are still high, so those monthly payments are still really hefty for a lot of buyers. Plus, there's that economic uncertainty we talked about, right? It's making people think twice about making big purchases.
Yeah, that makes sense. So are we looking at a disappointing spring market?
Not necessarily. Altos Research points out that sales usually pick up through the Easter holiday, which, falls in April this year.
Yeah.
But we do have that economic slowdown to think about. It's not just about affordability at this point. It's buyer psychology. If people are worried about, their jobs or the future, they're less likely to jump into the housing market, even with those tempting rates.
I see what you mean. It's like seeing an amazing deal on a new car, but you hold back because you're worried about job security. Now, Redfin's data also showed a really interesting regional variation. They found that Los Angeles is actually kind of bucking the national trend. Both pending sales and new listings are actually increasing there. They say this is due to a few things, including the aftermath of those wildfires we saw back in January.
Yeah, disasters like those fires, they often create some unique market dynamics. You have homeowners who are displaced and need to buy quickly, and then there are buyers who paused their searches during the disaster but are now getting back into the market. And then you also have some sellers who might be seeing this as an opportunity to capitalize on that increased demand.
So even within a national trend of, slower sales, there are these pockets of activity that are driven by very specific local factors. What would you say is the main takeaway here for our listeners?
I think it's that hyper-local knowledge is more crucial than ever. You really need to be tracking those regional trends, identifying those unique market pockets, and then tailoring your strategies accordingly. Remember, even in a slow market, there are always opportunities if you just know where to look.
And speaking of knowing where to look, the Altos Research video had a really surprising insight about the condo market. It seems like everyone's so focused on single-family homes these days, but condo inventory is actually growing faster.
Yeah, and not just growing faster, but in some places, condo prices are actually staying flat or even dipping a bit. Altos mentioned that in Florida, the median price for condos newly under contract is actually 4% lower than it was last year.
That's a pretty big difference. What do you think's driving that?
Well, it could be a few things. Maybe buyers are starting to prioritize affordability over having that single-family home, or it could be a lifestyle shift with more people wanting the convenience and amenities that condos often offer, especially, in those urban areas.
So for our listeners who mostly focus on single-family homes, this could be a good time to maybe branch out and explore that condo market, especially if they're working with first-time buyers or clients who just want a more manageable property.
Exactly. Condos can be a great option for those buyers, and with inventory going up and prices potentially softening, it could be a win-win situation.
Okay, so we've talked about mortgage rates, buyer behavior, those regional variations, and now this interesting development in the condo market. Let's zoom out a little and look at the bigger picture. What are the experts saying about the overall economic outlook?
Well, the NAR, the National Association of Realtors, just released their existing home sales data for January, and it gives us some clues. Sales were down 4.9% from December, but here's the thing, they're still up 2% compared to January of last year.
So sales are down month over month, but up year over year. It's a little confusing, to be honest. How do we make sense of that?
It really is all about context. December is usually a slower month for real estate, so a dip in January isn't all that unusual. The year-over-year increase, well, that suggests there's still a decent amount of demand out there. It's just not the frenzy we saw, in the past couple of years. Things are cooling off a bit.
So not doom and gloom, but not a runaway train either. What about prices? Are those finally starting to come down?
Well, the national median existing home price for January was $396,900. That's up 4.8% from a year ago.
So still climbing, but at a slower pace.
Mm-hmm.
It feels like we're in this weird in-between phase where things are shifting, but it's hard to tell exactly where we're headed.
I agree. And this is where those regional variations we were talking about earlier, they become even more important. The NAR report breaks down price growth by region, and there are some pretty big differences. For example, the Northeast saw the biggest gain at 9.5%, while the South had a more modest increase, just 3.5%.
So even though prices are generally going up, the pace of that growth really depends on where you are. It just underscores the importance of understanding your local market. What's happening in one part of the country could be totally different from what's going on in another.
Absolutely. And speaking of those regional variation, let's talk about inventory. The NAR data shows that the inventory of unsold listings at the end of January was up 3.5% from December and a huge 16.8% from last January.
So more homes on the market. Does that mean we're finally heading towards a more balanced market?
Well, it's a step in the right direction, but we're not quite there yet. To really get a sense of where the market stands, we should look at something called months of supply. It basically tells you how long it would take to sell all the current inventory at the current pace of sales. In a balanced market, you typically see around 6 months of supply. In January, we were at 3.5 months.
Okay, so even though inventory is increasing, it's not really increasing fast enough to shift the balance of power, right?
Yeah.
We're still in seller's market territory, but it's definitely something to keep an eye on.
Yeah, exactly. It's not time for sellers to panic or buyers to get their hopes up too high, not yet anyway. But it does suggest that things are slowly starting to change.
Now, along with inventory, time on market is another key indicator we always watch. What's the latest on that?
The NAR data shows that in January, it took an average of 41 days for a home to go from listing to contract. That's up from 36 days a year ago.
So homes are sitting on the market a bit longer. Does that give buyers a bit more negotiating power?
It could, but again, it really depends on the market. In some areas, homes are still flying off the shelves, while in others, they might be sitting for weeks or even months. Your local knowledge is going to be crucial here.
Right. Okay, so we've covered sales trends, inventory, time on market, and we've touched on those regional variations. Now let's circle back to the economic outlook. We've got these mixed signals, lower mortgage rates, but slower economic growth. What are the experts saying about how this might impact the housing market going forward?
Well, Lawrence Yun, the chief economist for the NAR, had some interesting things to say in his response to the latest jobs report. He pointed out that, while the economy is still adding jobs, the pace of that growth is definitely slowing down.
Not exactly a positive sign, is it? Does that mean we should be worried about a recession?
It's definitely something to watch. Yoon also noted that the unemployment rate in February ticked up a bit to 4.1%, which could mean some loosening in the labor market.
So not all bad news, but definitely some signs that things are, cooling down.
Right. And that economic uncertainty is probably a big factor in those lower mortgage rates we're seeing. Investors are getting nervous, which pushes those bond yields down, and in turn, mortgage rates follow.
It's like a domino effect. but with a lot of moving parts and a lot of uncertainty about where those dominoes might fall next.
Exactly. And there's one more piece of the puzzle I want to bring up. Jessica Lautz, the deputy chief economist at the NAR, she highlighted in her response to the mortgage rate data that even though rates are falling, homeowners themselves might not be feeling financially secure enough to move.
So it's not just about buyers being hesitant. Potential sellers might be holding back too, and that could really impact inventory levels down the line.
It sounds like there's a lot of wait and see going on right now.
That's a great way to put it. You've got buyers hesitant to buy, sellers hesitant to sell, and everyone trying to make sense of these crazy economic conditions. It's a very complex and dynamic market out there right now.
Well, that's why we do The Wire, right?
Mhm.
To try and help our listeners make sense of all this and make good decisions for themselves and their clients.
Absolutely. And speaking of making smart decisions, there's one more important thing we need to talk about, and that's the impact of tariffs on the cost of new homes. This is something that could really have a big impact on the entire housing market. Okay, tariffs. This is something we've been hearing a lot about lately, and it's definitely causing some concern in the housing market. So let's break it down for our listeners. How are these tariffs actually impacting their clients?
Well, it all comes down to this. Those tariffs on goods from, places like Canada, Mexico, and China, they're driving up the cost of building new homes. Think about it. A builder needs lumber to frame a house. Canada is a big supplier of softwood lumber, and those tariffs make that lumber more expensive. Those costs, well, they get passed down the line, first to the builder and then ultimately to the buyer.
Right. So it's not just lumber, though, right? We're talking about all kinds of building materials here.
Exactly. It's everything. Lumber, drywall, roofing materials, even the appliances and fixtures that go into a new home. CoreLogic is forecasting that the cost of building materials overall could jump by 10% in the next year. And get this, the cost of household fixtures could increase by as much as 20%.
Wow. Those are some pretty big numbers. Sounds like this could really put a damper on new home construction, especially when you combine it with all that economic uncertainty we talked about earlier.
Yeah, it's a valid concern. The National Association of Home Builders, they've been sounding the alarm about this for a while now. They're seeing builders getting more and more hesitant to start new projects because they just don't know what those projects are going to cost in the end.
And that hesitation from builders just adds to the inventory shortage that we've already been dealing with, right? Fewer new homes being built means fewer homes for buyers, which just keeps prices high and the competition fierce.
Exactly. It's this kind of vicious cycle. Now, there's been some talk about the U.S. increasing its own production of building materials to try and, offset the reliance on those imports. But experts are saying that could take years to really have an impact.
So in the meantime, builders and buyers are kind of stuck in this tough spot, having to absorb those higher costs.
Yeah, unfortunately, that's the situation right now, and it creates a lot of uncertainty for everyone.
Well, it sounds like we're going into a spring market that's full of contradictions. We've got these lower mortgage rates that should be attracting buyers. But then we've got affordability concerns, economic jitters, and now these tariff-driven cost increases hitting new construction. So what's the bottom line for our listeners? What's the one piece of advice you would give them as they're navigating this market?
I think the biggest takeaway here is that knowledge is power. Don't just rely on those national trends or headlines. They only tell part of the story. You need to really dig deep into your local market data, understand what's unique about your area, and be ready to adapt as things change. This spring, more than ever, the agents who are going to do well are the ones who are constantly learning, thinking critically, and coming up with creative solutions for their clients.
I love that. Don't chase the headlines, chase the knowledge. And that's really what The Wire is all about. Thanks for joining us for this deep dive into the spring market. We'll be back next week with more insights to help you stay ahead of the game. Until then, happy selling, everyone.
If you're interested in your own personalized edition of The Wire, please visit us at thewire.fm/custom. We offer market-specific podcasts with all the latest real estate news and market analysis delivered to you weekly or monthly. Own your market with a personalized edition of The Wire, the week in real estate. Thank you for listening.